Let's welcome on board Timothy Edwards, who's the Director of Index Investment Strategy at S&P Dow Jones Indices. He joins in to talk to us about what he made as far as the message from the Fed goes. Tim, thanks so much for taking time out for us. You know, the Fed seems to have surprised with a slightly more hawkish tone, but at the same time, it's assured the markets that it will keep short-term interest rates low for considerable time. Is that how you read the Fed statement?
That is how I read it. I would actually say I don't think this was much of a surprise. Sure, there was a reaction within the bond markets and within the gold markets that would suggest people were surprised by this. But the market can react pretty strongly even when exactly what was expected happens. We got more or less bang on what we were expecting.
Tim, the Fed says that there has been substantial improvement in the jobs outlook and that the labor market slack is gradually diminishing. Clearly, the Fed is becoming a lot more confident about the economy. Would you agree to that?
When the Fed started this last round of quantitative easing, the unemployment rate in the United States was around 9%. Now, as they close the books, the unemployment rate is 5.9%. The economy has improved, and the Fed aren't the only ones who see that to be the case. With expectations of US economic growth of between 2.6% and 3% shared by both the Federal Reserve and the rest of the market, things look rosy there.
Given the surprisingly hawkish tone that the Fed seemed to have adopted this time round, do you see hiking rates sooner than October 2015 time period that most folks have in mind right now?
If the data that the Fed reads continues in the manner that it has done, so in the same trend, yes, there is a considerable risk that there will be an interest rate slightly earlier than previously expected. And in fact, there's language in the Fed statement to allow for that. However, there was no mention in their statement of either Europe, where concerns are very material, or the recent bounce of volatility. So, on balance, I think we're roughly where we were in terms of expectations.
Something else that the Fed pointed out too was, worries on the inflation front. It has said that lower energy prices, amongst other factors, are holding inflation down, but should, progress towards the central bank's 2% target. Do you see any risks to that?
There certainly are risks. On the one hand, the market is pricing in inflation much below the central bank's target in the medium term, and wage inflation is practically non-existent in the US. On the other hand, the Federal Reserve is currently sitting on an extraordinarily large $4 trillion balance sheet, and there's no playbook for how to exit that. If the velocity of money, the speed at which money circulates the economy, picks up at all, we could have considerable inflation risk to the upside. So, considerable risks there.
Right. Indian markets seem to have taken the Fed's statement in their stride today. In fact, we even touched a lifetime high. Experts are convinced that we are better prepared to weather any sort of global shocks. Do you see a sharp correction for us should, the US decide to hike rates anytime soon?
Whenever there's a hike in US rates, and there eventually will be one, there will be a de-risking within the equity markets, and emerging markets are particularly sensitive to that. However, as you state, the Indian markets have particularly strong fundamentals at the moment, and they've been holding up well, and more importantly, decoupling from the tosses and turns of the US markets. Lastly, this rate hike, when it does come, is going to be one of the most anticipated rate hikes ever. So I don't think people are going to be caught out and surprised.
Tim, the focus now shifts to Europe, where there are growing calls for the ECB to even start considering a QE-style stimulus program for their own self. Do you see that happening?
No, I don't. The rest of the world might be calling for the ECB to purchase Greek and Portuguese government bonds. The German public certainly don't want them to. The ECB doesn't have a mandate to pursue the kind of policies that the Fed did, and it's not going to be getting it soon.
All right, Tim, we'll let you go on that one. Thanks a lot for joining us on the show this evening.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.